Hello and thanks for watching this video. I'm Alan Austin from Caliber and I'm here today with Mark Wooster. Mark is the Chief Investment Officer for Caliber Investment. He and his team are responsible for managing the investment solutions that your advisor has included in your portfolio. Given the recent events in markets, we thought we'd take this opportunity to have a chat and give you some insights into what's been going on. You'll see a summary of the specific things that we're talking about in the video shortly. So, Mark, what's the situation here? We've been seeing markets bounce around now and correct for quite a while. What's actually happening?
Yeah, well, I think the main driver of which markets really don't like, both bond markets and equity markets or share markets, is really just a big rise in interest rates. And the reason for that is that the central banks essentially are playing catch up with inflation. So inflation is the big driver here. We've got levels of inflation that are, we haven't really seen double-digit inflation. We haven't really seen since the 70s and 80s. So obviously, people our age have seen this before, but there's a lot of people out there who haven't seen this sort of thing before.
So, in technical terms, we'd call that a tightening cycle.
Yeah.
How far through this cycle do you think reserve banks around the world actually are?
Yeah, I think we were hoping that they were going to be a fair way through at this stage of the game, but what's becoming pretty obvious is that the inflation is going to dominate this landscape for a while yet, because the problem is the central banks have really let the inflation genie out of the bottle. So it's gotten to levels where, not only high headline levels, it started off on the supply side, the war in Ukraine pushing fuel prices up, the pandemic causing supply chain issues. So what's happened though, as the economies have opened up and unemployment has reduced and so on, we're starting to see inflation expectations embedded on the demand side, if you like. So that's where employees are asking for cost of living increases, and then that then forces those employers that grant that wage increase to push prices up to cover the wages, and then the employees who are also consumers obviously see the cost of living increase again and those increased prices and ask for a wage increase. And so this is this horrible vicious wage price spiral we hear from the central banks and the Treasury officials that keeps them awake at night. This is really, so for them what's occurring is they're worried, and I think it has started to bed in developed economies, is that this inflation expectation beds in at a higher level than what they really want. And I think that's why we're seeing this period of what we think will be extended interest rate rises to get this inflation genie back in the bottle, get it under control.
So from a New Zealand context, I think it's fair to say that the Reserve Bank here started tightening in terms of moving interest rates earlier, perhaps, than some other countries.
Yep.
Does that mean that we are close, perhaps, to seeing the rise of interest rates in this cycle?
Yeah, I think you're right, and I think it has put the New Zealand economy in better shape, because that was part of the problem, is that at the beginning of 2021, when developed economies saw that with the introduction of vaccines we were going to be able to open up the economies, and we saw evidence of that, that's when they probably should have started scaling back some of the stimulus, the central banks and governments, but mainly the central bank stimulus. So as you say, the Reserve Bank of New Zealand has started earlier, and the other thing, unfortunately, New Zealand is one of 3 serial offenders in terms of household debt. So we have a lot more household debt than other developed economies. Like, for example, in New Zealand, our household debt is well north of 100% of our GDP. So what that means is that with rising interest rates and with more household debt, the impact of those rising interest rates on the real economy, on demand in the economy, will actually bite a bit harder and sooner. So we are, in terms of the central bank response, yes, it's fair to say it's probably been a bit better than other developed economies.
But the real risk here is that the Reserve Bank actually pushes interest rates too far, too quickly, and we then end up with what's known as a hard landing.
Yes.
Which doesn't sound very pleasant.
No, it's just like a plane, you don't want a hard landing. and that's exactly right. So what the central banks around the world are trying to do is engineer a soft landing. So the US Federal Reserve Chairman Jay Powell came out at Jackson Hole, their gathering of central bankers. He came out and said, look, he'd like to see a way where they could do this without pain, but he said there isn't. And so what he's signalling there very strongly is he thinks there's going to be a recession, but what they're trying to engineer is a soft landing. So a soft landing is a bit of an uptick in unemployment, and a bit of pain, rather than a hard landing, which is a really big uptick in unemployment, business closures, pain and disruption, and a long time in terms of coming out. So obviously nobody wants that. So that is the hard versus the soft landing. And so that's what the Reserve Bank is trying to achieve here, and that's what central banks around the world are doing. The problem New Zealand has, of course, is we are a small open economy. That's really good from a trading perspective, but it does mean we are also subject to what happens globally as well. So what happens in the US and what actions the US Federal Reserve take are going to impact us here, and we're already seeing quite a significant impact through our currency. So our currency is devalued about 20% against the US dollar.
So what has that meant then for investors? Because we've heard some stories of quite significant impacts on investor portfolios, sometimes negative returns of up to 20 or 30 or even 50% in some instances. Yeah. How should investors react to that?
Yeah, it's probably pretty obvious how they react to that. But that's a really good question because, just quickly on the reaction point, it's quite important actually, because we've seen in the news just recently that just about $2 billion worth of KiwiSaver funds for people who are over 65, because obviously under 65 people can't withdraw their funds, but over 65 people have drawn down on their KiwiSaver, or actually closed their KiwiSaver accounts. And so we don't really know where that's going, but we suspect that money's probably gone back to term deposits, or rather what they think would be more stable investments and a smoother ride for them. The problem with that approach, though, is that as funny as it sounds, cash or term deposits is the riskiest asset for a long-term investor.
That's completely counterintuitive, I think, to most people. Yeah. Tell us more about that.
Yeah, well, what that means is that cash is the asset that is least capable of dealing with inflation, and inflation is the biggest threat that most investors will face over a long period of time, because even at just 2% inflation over a 20-year period, prices can increase 50%. So that's massive. So that's a really big reduction in the average investor's purchasing power. So obviously that's a really core objective that we try to address in the portfolios. So the big problem with people getting spooked by the level of volatility you spoke about, and it's perfectly understandable, and then jumping out to what they think is a safer asset. The trouble is that asset is not the safest asset over that extended horizon. So the big problem there is, what's disturbing is that it's disrupting what should be effective planning for that investment horizon. So I think this sort of market outturn and this sort of outcome for investors is really problematic. I think it can do real harm to people's wealth in terms of the purchasing power, effective strategies. What we also see quite a bit, and you and I discussed this a bit, is people jumping into okay, that option wasn't great, too volatile, I'll go over here, I know this, jumping into different types of, and some of it unfortunately is taking advice from the neighbour across the road that's done well in some sort of investment. So as we know, that's not an effective strategy. And so I'm really worried that it's going to cause some real problems in terms of people's wealth.
And so, we've talked about this before, what's critical here is making sure that your objectives as an investor are aligned with the degree of risk that you're comfortable with, but the degree of risk that you need to take to reach your objectives, and then aligning that with an appropriate investment solution Tell us more about that.
Well, so that's right. So, what you've got to do is have a process where you do outline exactly what you're trying to achieve. One of the critical points is determining what that investment horizon looks like. And then what we do at Caliber is we work really hard to make sure that the investment solutions are properly aligned with those objectives. And so right down to our core components of the portfolios, we make sure that the level of diversification, the quality of the underlying processes, and ESG and sustainable issues are addressed within each component. And then we work really hard to make sure that the combination of those exposures works effectively. The one big thing that needs to happen in people's portfolios, and as you said, this is another counterintuitive issue, is that they will probably have to take on a bit more risk. And so we know that in investing, any extra return accrues to taking on a bit of risk. So if you've got a risk-free asset, say cash, then to get past cash returns, you have to take some risk on. Why do people have to take on risk? Well, they have to take on some risk or capture a bit more return to try and combat that inflation thief, because as we said, for a long-term investor, that's probably the biggest or one of the biggest challenges they will face. And so what they need to combat that is to take on a bit more risk in their investment. So that's the critical issue, is how do you manage those risk exposures? And that's probably where most people get into trouble.
We've also talked in the past about how important diversification is in portfolios. And we've heard a lot of stories about people that have made a great deal of money in terms of investing in the New Zealand share market, the Australian share market, but that doesn't necessarily constitute good diversification. Perhaps you can talk a little bit more about that.
Yeah. Well, one thing that most investment managers throughout the world agree on is that effective diversification is one free lunch where there are many free lunches. So, and why it's important is what we're after is actually trying to access, risk exposures in an effective way. And as you said, that some people, and we've seen it in the recent past, and we're seeing some of the effect of that now, is that when things are running hot, if you're over allocated to a certain sector that is running hot, you can look like you look like you're very smart, and and you get some outsized returns, which of course everybody likes. But the problem is that with concentrations of risk come the other side of the coin, which is when the downturn comes, those concentrations can crash a lot harder and a lot further. And so the big problem with risk, especially around asset classes like equities, is what we talk about is the mathematics of volatility. And what that means is if you had $100 and it falls by 50%, you've got $50. If that $50 increases by 50%, you're still underwater because you've only got $75. You're still 25% underwater. So that's one concept we work very hard on, is because equity markets especially can be quite volatile. They offer the best return because of that volatility. People demand a higher premium to be involved in the market, which is great, but the volatility can be quite confronting, and it doesn't always suit people's requirements, and especially our types of investors who don't want to be worried about their portfolio bouncing up and down and all over the place when they're just trying to deal with real life challenges like dealing with inflation, helping family out, lifestyle requirements, replacing cars, fridges, and so on.
So if you're a long-term capital investor who has a lump sum, and perhaps you've sold a farm, you've sold a business, you've retired, you've cashed in your KiwiSaver, and you've now got a portfolio that's sitting in the market, and you're potentially looking at drawdowns on that portfolio of, say, 30 or 40%, that's going to seriously compromise your ability to live your life. But alternatively, if you have a portfolio that's only suffering, say, a 3 or 4 or 5% drawdown, so what's the difference between those sorts of portfolios?
I think in real terms for people it's certainty. because at 30-40% down, you're going to need a 55 to 55% increase to get back to square one. Whereas when you're only 3-5% down, you don't have to have those gains to get back. And so when a portfolio drops that much, there's a much higher level of uncertainty as to what the outcomes are going to be, how long it's going to take. Well, that affects people's ability just to live their ordinary lives with these real life challenges. And so that's why a lot of funds management focuses on beating benchmarks and heroic management in terms of targeting a stock or a group of stocks that does 50 or 60%. But that doesn't in reality suit our types of clients very well at all, because what they're really after, as I say, is just to lead their normal lives without all of this uncertainty. And so what we do to effectively combat that is diversify not just within the asset classes but across asset classes. And it's those combinations of assets that actually help you have that lower downside capture, which is what you're talking about, not dropping so much, so that the mathematics of volatility works in your favour, not against you. So that's what unfortunately some clients have experienced out there with some funds, where they have focused on mega cap growth stocks and a lot of bonds and less diversification, more higher concentrations. And while times were good, last year, while interest rates were still low and things were going well, those funds were clearly doing very well. But since we've seen inflation really kick in, interest rates rise really hard and fast, and they have done because the central banks are trying to play catch up, what we've seen is some pretty nasty surprises for people. So you're hoping that those portfolios will come back, but whether they do or not, what's become very obvious, I think, to a lot of investors, and I think that's why you've seen a lot of those people pulling out a KiwiSaver, is that sort of result just doesn't suit what they need. And that comes back to that, what you were talking about before, is how well aligned are the portfolios with your objectives.
Just a question about income versus growth. And traditionally a lot of investors, once they had stopped working, would invest in a portfolio that was specifically income oriented, because that was what they wanted. And as a consequence of the significant reduction in interest rates globally, people's incomes have been quite significantly diminished. And so we then saw fund managers offering product that were labelled as income, but in fact often had a significant degree of equity exposure in them, because those were equities that paid very high dividends. And also with that, a consequent increase in the volatility of those products. At Caliber, we don't necessarily talk about income, we talk more about cash flow. Perhaps you'd like to elaborate a little bit more about that and why that's important.
Well, it sounds like such a simple concept, right? So talking about cash flow versus income, but as you said, and it's quite natural for investors to think in terms of income, because they think, well, I need income to pay for the groceries and other day-to-day things, and they sort of compartmentalise their portfolios of saying, well, I need the income to pay for the groceries, but if I want to replace the car or go on a world trip, maybe I do need it to eat into the capital a little bit. And so we do think a little bit differently, because, as you say, the desire to create income, actually, again, this is another counterintuitive point, is that it's what we call skews portfolios. So it skews portfolios in a way that people end up with assets and exposures that again, it's counterintuitive, act against them, and they create a lot more volatility. As you said, people were investing in some riskier assets. So what people have been doing, and it's an interesting concept, is when interest rates dropped right away, they were trying to replace that income, but to do that, when interest rates were really low, to do that they had to take on a lot more risk. And again, those risk exposures didn't necessarily align with what their requirements are. So the approach we have with just shifting from an income perspective to a cash flow is it allows everything to relax a bit. So the client can say, well, I need this much each month in terms of cash flow. And what we can do is provide a very well diversified portfolio where we can just meet those cash flow requirements without skewing the exposures, and in a way that helps manage the risk exposures in a way that's much more aligned with their requirements. So I think it's a very simple concept, and I love the work that advisors do with clients when they're working through that, because I think it's one of these simple bits of advice that can really make a big difference in the outcomes for clients.
So a slightly more technical question, and it's focused around a lot of the big name tech stocks that we hear about and how those have come to dominate the market, and investors will be familiar with those. What part has that played in current events, and how have exposures to those sorts of stocks impacted on people's portfolios?
Yeah, well, I mean, that's actually impacted a lot of ordinary investors in New Zealand. So it seems like a long way away, these big tech stocks like Apple and Metaverse and so on. So what happened with really low interest rates is those stocks, for technical reasons, really took off. And we saw, some famous concentrated portfolios doing returns like 147% and so on. And so some investors and managers actually ended up either inadvertently or as a strategy ending up sort of concentrated in those stocks because they were the ones producing these outsized returns. But what's happened with just as they were beneficiaries of low interest rates, as high interest rates have, or as interest rates have risen and taken off, they're obviously been some of the worst performers. So some of those big stocks are down 40-50%, believe it or not. Massive companies have suffered really big drops, and that has been part of the experience of some investors in New Zealand. And so, look, we don't want to give the impression that all funds have been subject to this or that people should avoid funds because of this. Quite the reverse, actually. But you do want to make sure that where you're invested has a solid process of risk management and avoids concentrations of risk like that.
A quick question then about index funds
Yeah.
and costs.
That's a really good
Because a lot of investors get sucked into the idea that if it's cheap, it has to be good.
Yep.
And if it's an index fund,
Yep.
it has to be good. And that's not saying that index funds don't have their place in portfolios.
Totally, yep.
But investing entirely in a portfolio of indices, can have some real pitfalls and real ramifications for your long-term objectives as an investor. Perhaps you can elaborate on that a little bit.
Yeah, well, I think index funds have been great because they have shown people that there is a way to try and get a broader exposure in the market at a much lower cost. And so when you think of it in those terms, it's got to be good. The only problem we have is people tend to think of index funds as being the gold standard of diversification. And the problem is they're not, because a lot of the popular indexes, for example, the S&P 500, there's 6 stocks or 6 companies in that index of 500 companies. Those 6 companies make up 25% of that index. So clearly that's not broad diversification. And what we've seen in this recent market dynamic is that those big tech companies, as they grew at a faster rate than the rest of the market, they became a bigger proportion of those indexes. So of course, when they crashed down, some of those indexes have had really actually quite poor results. And that's been a real surprise to investors because they thought, well, I thought I was in a well-diversified portfolio, and it's really crashed down much more even than the broader market. So that's a little bit of a misconception. And so again, when you're dealing with index funds, you've really got to make sure that you understand what your true exposures are, and be aware that even though they look like they are broadly diversified, that you can get real concentrations of risk that that we've seen. The performance of is not great at times. So just to wrap up then, what do you think the lessons are that investors should take away from what's been happening currently? Yeah, I think the number one lesson, what we're seeing out there, it's quite fascinating, is that perfectly normal is that in times of volatility, people's risk appetite diminishes quite a lot, and so you see people acting what seems like perfectly rationally, saying, look, I want to reduce the risk, reduce the pain, which is perfectly reasonable. I think the big takeaway lesson is, though, have a plan, understand that these rough patches are going to come along, often on a regular basis. We don't know when they're going to occur or how. Understand that it's all about risk and risk management, but stick with the plan, and I suppose talking our book a bit, get some advice, because it's pretty clear that in periods like this it does add a lot of value. It can help a lot.
Thanks, Mike, and thanks for watching. Hopefully you found that informative and interesting. There are other videos on the Caliber website, so please feel free to click on the links to those, and if you have any questions, feel free to contact your advisor or send us a question via the website. Cheers.